Okay, thank you. Good morning, everyone. So today I'd like to talk to you a bit about quant alpha, the nature of alpha that quant managers can expect in a world that is increasingly, let's say, less mispriced than before. So I'd like to convince you in the talk of four main points. First is that we've, basically since 2000, there has been sort of a sudden and dramatic elimination of a lot of predictability in financial markets. I'd like to show you a variety of evidence, and hopefully, that'll confirm, confirm some of your priors. And then I want to say, well, what does that tell us about the nature of alpha that quant investors can expect? In a world where a lot of things just aren't really that mispriced, how does a quant strategy turn that into significant annual performance? And so I think a way to kind of boil that down is that any manager that thinks in a world where there's modest mispricing, thinks that they can deliver significant alpha, significant double-digit alpha in a world where most assets are just not that mispriced, really relying on one of four stories for how they can accomplish that. So I'll go through those. And then that sort of has implications for quant investors, and in particular how quant investors can exploit modest mispricing in a context of requiring lots of data for statistical power to turn the modest mispricing into significant annual alpha. I think these three sort of most successful quant strategies on the equity side of things are sort of sorting firms according to various measures of value and getting long, high value firms and shorting the growth stocks. That has had a very nice run. Same with momentum strategies, namely looking back a bit over a year and sorting firms in terms of how well they've done over the past year, going along the firms who've done very well and short those who haven't done very well. And then finally, the short-term reversal strategy, which is, I think, the basis of a lot of the short-term quant trading. You saw very strong reversals in equities, really throughout the 20th century, and we'll see what those have looked like since then. The preview is not very good. So all three of these strategies, even pre-T cost, have basically been flat since 2000. Huge amounts of capital have gone into them. Maybe it's been armed out. Maybe to some extent it was just a feature of the 20th century that has changed fundamentally. But ultimately, all three of them have disappeared, even though really hundreds of billions of dollars have gone into them. So here you see with if you sort small cap firms where the effect is strongest, you take the bottom half of NYSE NASDAQ firms in terms of market cap, you sort them according to book to market ratios, you go along the firms that have high book to market ratios, short those with low book to market ratios. Very impressive run through basically 2002. You had a drawdown in the early 80s, a bit of a drawdown in the early 90s, big drawdown during the tech run-up, but it recovered nicely from that. But essentially, even pre-transaction costs, probably the juiciest of the value strategies, hasn't made really any returns. So momentum, also very impressive performance, actually very good performance during the tech run-up, did not suffer during the tech collapse, but suffered very dramatically, you can see there, during the 09 recovery of the financials. So a long, short 12-month momentum strategy was essentially short all the financials in the spring of 2009 and got really clobbered. But basically, since 2000, hasn't made any money. Even after the big drop in 2009, the momentum strategy pre-T cost has been flat. The final one, as I said, 1 month reversals. You can do this in weekly reversals or even daily reversals. You see the same pattern. Incredibly strong performance, at least pre-T cost through 2000. Probably less strong, but bigger gap here between pre and post T cost performance. But still, these strategies did incredibly well. Stat arb sort of approaches did incredibly well till about 2000. Since then, basically flat. You get the same story if you look at intraday inefficiencies. And here, let's look at a slightly different asset class. Look at the global macro universe. If we look at sort of intraday return autocorrelations for bonds, for equity indices, for commodities, for currencies, you see the return autocorrelations have all kind of collapsed towards zero. Same thing for the cross autocorrelations. So here's the graph. So for most of these asset classes, you had at the 15-minute sort of return horizon, very strong negative autocorrelations. But as you see, the sort of average absolute correlation is about a third of what it used to be at the in the late 90s. Same thing's true for 15-minute cross autocorrelations. So if you take sort of one of the major assets within the asset class, say take the S&P 500 in the equities asset class, and you correlate that with, you lag that relative to the other equity indices, you see fairly strong positive cross autocorrelations. The S&P returns were leading the returns of other equity indices. Same is true for the euro leading other currencies, the oil rates and ags. So you see over time, though, that average has declined pretty dramatically. Again, maybe a third of what it used to be. So the spillovers intraday are just not what they used to be. A lot more capital in there arbing this stuff out. So what do you take away from this? For me, all of this evidence tells me the world is just much more efficient than it used to be, and in particular, the difference between the price of assets and their fair value just is not as dramatic as it used to be. The opportunity to take advantage of mispricing just isn't what it used to be. Maybe one way to describe this is sort of a lot is mispriced by a little is mispriced by a lot. That is, there's some things out there that are still very mispriced, but they're few and far in between. A lot of stuff's off by a little bit, maybe a couple % off here and there. But it's not at all to say that we're not going to look back and find that Lyft was a really good buy at its current price. But based on what we know right now, I think there are just too many people watching that stock and other liquid stocks to be confident that they're off by more than a few %. There's too much money, too many people have gone into this line of work. So the question is, we all want double-digit alpha. How do you deliver double-digit alpha in a world where a lot is mispriced very modestly, few things are mispriced by a lot? So I would say, as I said, there are essentially four basic ways to turn modest mispricing into significant alpha. If someone wants to invest your money and says that they can do this for you, essentially they have to be, I would say, telling you one of these four stories. If they're not, they are either deluding themselves or misleading you. So the first one is, of course, leverage. You can take modest mispricing, turn it into significant alpha if you employ leverage. The problem with leverage, of course, is it's not just the returns that go up, it's the risks that go up. So how do you manage the risks? There are two ways to manage risks. One is to make many bets, that is, diversify in the cross-section, hopefully have the imprecision in your bets kind of cancel out, and then you keep the returns, you don't have the risks. Unfortunately, it's not that easy. You think that the imprecision in your bets is going to be independent, and it might look independent, but often you find during bad times that you have some hidden factor exposure, and so the bets aren't as independent as you would like. Even if there's no hidden factor exposure, you often see that capital tends to chase the same kinds of bets, and the trades become crowded, and a new factor emerges out of thin air. So the first way to eliminate risk is through by making a lot of bets. The other way is, of course, to hedge the risk. So if we think that the New Zealand dollar is underpriced by a couple %, we want to really turn that into 10% return. We've got to short the Australian dollar to take advantage of that mispricing. That strategy will, of course, require that correlation to stay high, and Usually it will, but the problem is that breakdown in correlation often occurs when other correlations break down, and often occurs when other bets in your investors' portfolios haven't done well. So leverage is certainly a good tool, but not as easily done as it is said. So there we go. Illiquidity. Second way to turn modest mispricing into a lot is go away from the stuff that's actively traded, go to the stuff that is very illiquid and perhaps more opportunity. So I think here, I'm always reminded of this student of mine who once told me to invest in Bulgarian real estate. He said Bulgaria is going to join the EU, and it's the farmland's trading at 20% what the French farmland trades for. If you invest in Bulgarian farmland and they join the EU, it's going to trade at 50% of French farmland. You're going to make a lot of money. I have no idea if he was right. I have no idea, even with the benefit of hindsight, if it turned out to be right. But what I can tell you is, certainly could have been right. There's just not enough money arbing the French versus Bulgarian real estate markets to keep them nicely in line. And so certainly could have made money. If he had said that Microsoft was off by 50% relative to Apple, I would have thought that's pretty implausible. So that's the attraction to illiquid assets. Certainly should be a part of your portfolio. But I will sort of give you a bit of a caveat here. I think that there's a lot of money going into private equity and so on, sort of thinking that there's this illiquidity premium that they can take advantage of. And I think that's a little bit misguided. So if we think about private equity and we want to try to isolate the illiquidity premium that it's earning, we have to say, well, what kind of assets is private equity putting into those portfolios? If we found similar assets that were just more liquid and put them into a portfolio, what return would we have earned? If you sort of look at the performance of private equity since the 80s, very impressive performance, even after fees. You look at that, you say, okay, fine, there's probably some return smoothing, but certainly very impressive. Maybe that's earning an illiquidity premium. I think the evidence is pretty starkly against that. So if we find, as I said, if we find similar kinds of assets and we employ the same kind of leverage to those assets that private equity firms are employing, but we just find liquid public versions of those assets, you actually do just as well as private equity. So a simple strategy would be to buy all publicly traded firms with high EBITDA multiples, like similar kinds of firms that a private equity firm might find in the private markets or might take private, fund it with 50% margin, that is levered up 2 to 1, and then let's even give ourselves the benefit of hold to maturity accounting that the private equity guys employ. That is, let's only look at our portfolio when we remove something from the portfolio. Otherwise, we'll just keep it marked at the price we went in at, and we'll turn over the portfolio very gradually. If we do that, you see that we can actually achieve with these high EBITDA public firms what private equity has earned, and in fact, we can match their pre-fee performance. So you see the dotted line is the smooth version of our portfolio. Our portfolio is, of course, much, much riskier than the private equity portfolio. Delivers the same alpha, but with way more risk. You clearly would argue, seeing this graph, well, probably what's happening is not that somehow private equity is able to eliminate the risk. You don't eliminate risk of assets by taking them private and levering them up 2 to 1. That risk still is in there, but marking the portfolio only at exits is certainly going to help you from a risk standpoint. So I don't think that what private equity is offering is some kind of liquidity premium. There's some evidence that private equity is creating value in other ways, but I just don't think that most of the returns that, say, private equity portfolios are earning are just for holding illiquid assets. But certainly illiquid assets are a good part of any diversified investment strategy. But I would say they're more adding value in the sense that there's mispricing that can be identified. As a whole, private equity, there just to me is not that much evidence that they have identified and exploited that mispricing. So the third possibility is you've got to concentrate your portfolio. We said lots mispriced by a little, a little is mispriced by a lot. Well, let's focus on the very small number of opportunities out there that are very mispriced and place a big bet. So we'll put all of our eggs in one basket, watch that basket very closely. That's kind of what the activist investors are doing, right? They're finding the few companies they think are really far off. They're getting a big stake in those companies, maybe trying to manage what the company's doing, or at a minimum, make the public aware of why the opportunity is so mispriced. And certainly that seems to have worked for them. There's some broad evidence that concentrating portfolios can deliver performance. There's evidence, the concentrated diversified mutual funds tend to outperform. If you look at funds and sort of order their investments according to how much conviction they have, how much tracking error that particular investment's producing for them, you see that the subset of investments they're making that are very concentrated, that are high conviction, end up doing very well. And it raises a couple of interesting questions. If there are these opportunities to concentrating portfolios and focus on them, why do managers avoid that? Well, that's kind of obvious, I guess. It's tough to, even though that might be in the interest of your investors, it's tough for your career to take that much career risk by putting all your money on a small number of investments. There are plenty of risks you can't control when you do that. From an investor standpoint, clearly the right thing to do would be to find a bunch of very undiversified investors that are making very high conviction bets, and managers that are making high conviction bets, and then diversify among them. But even investors don't tend to like that. I guess it just ends up being more difficult than you would think to explain to your bosses why one of your investments blows up, even if the others are doing very well. So investors and managers tend to not like concentration, even though it's probably there's, I think, some pretty decent evidence of it adding value. And then the final way to turn modest mispricing into significant annual performance is through velocity, by turning your portfolio over frequently. Essentially, if you have let's say a dozen basis points of mispricing that's going to close in a few days, and you can get in and out without tremendous execution costs, you can turn that into double-digit returns across a year if you can make that bet many times. As I said, though, the key is keeping your execution costs low. There just aren't a lot of assets out there where we can trade many times per year and not have our execution costs go through the roof. So I think this, to me, brings up kind of the fundamental trade-off at the heart of most quant investing. So quant investors are trying to get lots of data, trying to make lots of bets and get a lot of evidence that their strategies are working. But of course, pushing back against that are the execution costs. So high turnover leads to a lot of observations, a lot of statistical power, but of course, a lot of execution costs. One way to improve that is by increasing breadth in the cross-section, adding a lot of additional bets in the cross-section. But of course, as I said, the number of investments in the cross-section that have low execution costs are pretty limited, and so as you increase breadth in the cross-section, you're also raising your execution costs. And I think that's kind of the fundamental trade-off that's at the heart of most quant investing. So to explore that a bit, let's go through an example. Let's say we have 50 independent assets with 20% vol, and we're going to vary the investment horizon from trading intraday to trading once a month. And let's give a signal that's 1% of the holding period volatility. That is, we're able to forecast 1% of the total movement in each of these assets across our holding period. Will give us a little bit of execution costs, and then ask which investment horizons in this setting do well. So pre-T cost, clearly the short horizon is going to do the best. So if we have a bunch of different draws from this from this Monte Carlo, you're going to see before transaction cost, you'd like to turn over your portfolio as much as possible, even though you're forecasting very, very modest alpha without any execution cost. You get to make that bet so many times that it turns into an impressive performance across the the sample. As you lengthen the horizon, of course, you're not making as many bets. It's true that your alpha is larger, but you're just not making as many bets, so the imprecision in your strategy grows on you. And clearly at a horizon of 50 trading days, at least under this setting, you just don't have a lot of confidence that your strategy is truly delivering alpha. From a post-T-cost performance, the picture changes. Of course, the trading very frequently is very nice in terms of statistical power, but now you've kind of convinced yourself you're going to lose your investors' money rather than make the money if you're trading very frequently. As the horizon lengthens, things start to look pretty good. You're paying a little bit in execution costs, but it's more than worthwhile because you're getting enough data to evaluate the strategy relative to these longer horizons. Again, as you go to the longer horizon, you're not paying a lot of execution costs, but you're really getting overwhelmed by the noise in the return process. So we can increase the breadth and make more bets. But of course, as we increase the breadth, we're going to have to go to assets that don't have as much liquidity. And now we're going to, at short horizons, those high execution costs are going to overwhelm us. We certainly don't want to be turning over our portfolio as frequently. Even at the horizon of a couple of days, we're still just bleeding money because of the high execution costs of this very broad strategy. And then as we get to slightly longer horizons, things look pretty good. But at the very long horizon, we're just, again, not making enough bets either in the cross-section or in the time series to be convinced the strategies are working. And then the final thing would be to isolate our investments on assets where we think we have very good signals. And those, of course, are going to, because we're going to have to search more broadly, going to be assets that have higher execution costs. And again, we're sort of guaranteeing that we're going to lose money at these short horizons. But then there will be an intermediate horizon, maybe pushed out a little bit, where this good signal is working well. And again, at the long horizons, the lack of statistical power ends up killing us. So, this is sort of summarizing all of that. I would say any quant strategy is going to be somewhere that's viable, is going to have to reside somewhere in this triangle. You're going to have to essentially pick two of the following three attributes. You can either have a strategy that demands a lot of liquidity and is high turnover, but you really are going to have to only trade the most liquid assets out there. You're going to have no breadth whatsoever in the cross-section. You could demand a lot of liquidity and have a lot of breadth, but you just can't turn over that portfolio very often. So you'll be way up at the top there. And then finally, you could be way in the bottom left. You could supply liquidity, have a lot of turnover, and do that for many assets. But of course, you've got to figure out how to supply liquidity. And then, of course, the power issues are really going to be pretty pronounced when you don't have either a lot of turnover or a lot of breadth in the cross-section. To me, the way to think about quant investing, you want to be somewhere in that green area, and it's not easy always to get somewhere in that green area. I think at the top, as we described, when you have a lot of breadth and you're crossing spreads, they're just low barriers to entry. That's why we saw those graphs all flattening out. Just the world changed, became much easier for someone with a Interactive Brokers account and a Bloomberg connection to put on very broad strategies and just cross spreads. So low barriers to entry at the top. In the bottom right, I think it's certainly possible to focus on very liquid assets and demand liquidity in those assets and have lots of turnover, but you have to stay small. As soon as you start impacting prices, you're out of business in the bottom right. And then the bottom left, it's going to be it's very tough to compete over there and supply liquidity with very high velocity in a lot of assets. And I think ultimately there's some pretty good evidence that if you're second best, you're last, as Ricky Bobby would say. He's from these parts, isn't he? I think so. All right, so I just briefly would say we tend to like the global macro asset universe in the context of that trade-off. I think the barriers to entry to high velocity quant strategies are significant. You have to deal with different markets around the world, different market microstructures where high velocity strategies certainly need to be properly accommodating. You have asynchronicity with liquidity around the world, and so you have, a systematic strategy is going to have to confront that asynchronicity to market hours and market liquidity. I also would say that the fundamental investors face pretty big barriers to entry in the global macro universe, and that perhaps, one could argue, creates more mispricing for quants. So for instance, if you had a mispricing from a Japanese to a Chinese equity, how many fundamental investors could really be confident in making that trade? How many investors out there speak both of those language, understand both of the market's accounting conventions, the regulatory regimes? So I think the fundamental investing, cross-border fundamental investing, is also probably pretty challenging, and that maybe one could argue creates more space for quants. All right, so we went through a lot of stuff. Just to kind of summarize it, I would say first point, mispricing is just far less severe and far less widespread than it used to be. To me, a good rule of thumb for thinking about the world today is a lot is mispriced very modestly. Here and there are pockets of inefficiency where significant mispricing remains. And in that world, you have to employ one of four strategies to deliver significant returns for your investors. You either have to put in some leverage, you either have to concentrate your portfolio or invest in a bunch of concentrated portfolios, you have to pursue illiquid strategies, or you have to put in very high velocity strategies to deliver double-digit alpha in that kind of world. And in that context, quant strategies kind of have to pick and choose only two of three things that they would like. You either demand liquidity, invest with a lot of cross-sectional breadth, or invest with a lot of velocity. You can't achieve all three. And as I said, the barriers to entry to very broad liquidity-demanding strategies are low, and the statistical power associated with strategies that don't have a lot of velocity or don't have a lot of breadth is weak, and so the quant strategies do not become viable. All right, that was a lot of stuff covered relatively quickly, but I guess we will leave it for questions after the third session. Thank you for your time.